Mike, if I start with you, kind of continuation of yesterday's theme, and you've also seen the VIX drop further still. Pretty bullish sentiment out there.
Yeah, the market's making the case that what we saw in August was just a little bit of an overshoot in the direction of recession fears, dragging bond yields well below probably where they fairly should be given U.S. fundamentals, and also getting investors positioned in a very cautious, fearful way. So all that stuff with about a 6% or so decline, peak to trough in the S&P 500, was pretty extreme. A lot of that's being reversed. We basically have the economy in terms of trend we thought we had in July. A lot of the data now pretty much confirm that at this point with the domestic consumer. And bond yields are a lot lower, and investors are not positioned for further strength in the economy. So I think that's why we're seeing this repricing. Does it really get you to escape velocity in terms of economic optimism and all the rest of it? No. But I do think it shows you that low bond yields are a benefit when the credit markets are still functioning well as they are right now.
Well, Jim, it started with a headline about the U.S. and China talks, trade talks, China being back on in October. I mean, been here, done that. How many times can the market trade like this off of the whiff of talks?
I don't know. It's been pretty profitable to trade on that for several times now. So traders, it's a haven. I guess it just continues. It hasn't done much for investors, though, because as Mike says, we're going nowhere fast, mostly up and down, and haven't escaped out either side of the trading range here yet. But, Sarah, what I'm most drawn to, I think back to that fateful tweet when when talks broke down and we had the August debacle here. We're kind of back up to the top again. What has changed, in my view, is that I think the economic momentum, economic reports, surprise indices around the globe have really started to break out to the upside. If you look at like Westpac's Global Economic Surprise Index, it has really made a significant upside breakout. And you can see economic surprise indices are way up here in the United States. It actually went positive here just today.
Where around the rest of the world? Pick out some countries.
Look at Citigroup Economic Surprise Index wealth in Europe. It's turned up in the last 30 days. Japan has been strong. Canada's just turned up last 30 days. Even the emerging markets are higher. Even China's gone up of late. Here in the United States, we went from -70 2 months ago to +7 today. So I think that there is some gravitas to what's happening here. The market not only refusing to break down significantly in the face of all this concern with yield curve inversions, negative yields, and trade wars, but also the chance that it could break out to the upside, and it continues to increase, regardless of what the Fed does, only because economic momentum seems to be shifting more positively.
Is that a sign, I wonder, Steph, that stimulus still works? I mean, that's what we've gotten this year from central banks around the world.
Well, fiscal stimulus works better than monetary stimulus, I would argue. But I do agree with what he was just saying in terms of the economic surprises, because look at the Baltic Dry Index. That actually is also now at a new high, too. So we're getting kind of signals that things are they're not going down anymore. Now, what does it do for global growth? I mean, are we going to still see slow growth? Absolutely, but maybe not recessionary, and that's what we were pricing in. So happy to see the leadership today very much. Happy to see a decent economic data. Now we get tomorrow's data, and hopefully everything doesn't turn upside down.
Mike, does the market still get spooked as it gets close to the all-time high label, even if that was first made quite a long time ago, and valuations might be better or interest rates might be lower?
It often coincides with an area where it seems like a logical place to stall out. I think that happened earlier this year for a little while. But honestly, I don't think it's necessarily we're going to look at that 3,000 level and say, oh, this is impenetrable somehow. I do think, though, the pattern has been making the new all-time high. It's been relatively brief. We've done that 3 times in the last year and a half, or 4 times, without it necessarily being, lasting.
Jim, do you think the policy support that is expected to come from a lot of the developed world in the coming weeks, is that already priced in, or is that an extra boost to come?
You know, I think if it comes as an extra boost, Wilf, because what I've been fascinated on is not what the ECB is going to do now or what the Fed may do now. It's what the market's already done. Well, we've taken the entire yield curve, except for the very short end, and dropped it by 150 basis points in the last 9 months in this country. We've had similar long-term interest rate moves across the globe, in China, in Europe, in Japan, in Germany. The German bund was plus 80 basis points in January 2018. It's now minus 60, so there's been a big easing by long-term investors there. So we've got money supplies up, we've got yields down, we've got fiscal stimulus here, and the lagged impact of that, now approaching 9 months to a year, I think is just starting to have its normal lag and is going to start to have positive benefits. One other thing I'd point out that's different right now from what it was when Trump tweeted a little over a month ago is we've just had a tremendous increase in fear, evident. We've had so much talk of recession. If you do a Google's trend search on the word recession, and it looks like flat as a pancake since the 08 crisis, and it just shot up to levels pretty close to 08 just last month. So there's a lot of fear combined with better fundamentals. It's always a nice combination.